Two stocks I'm buying in April of 2026. Those are two stocks, non-tech companies. So if you're a tech investor, you're looking to diversify in other compounders that could potentially return more than a 20% annual return, you might enjoy some of the stocks that I'm gonna talk about today. Those are stocks in my portfolio. I've been buying the dip on those stocks over the last few days. So I'm gonna talk about them, tell you about the business model, the upside potential, and my fair value in general. And I really hope you enjoy it as always. Now, the first one is CEG, which is Constellation Energy. The stock is down 25% year to date. Constellation Energy is the largest utility company in the world in terms of electricity generated, and it's not even close. The company is now so large that it produces about 7 to 8% of the US electricity supply here in the United States. I mean, this is becoming a really important company, a national security kind of play. And whenever you have, again, a company where if something goes wrong, if something happens to it, 8% of the US electricity supply would be gone overnight. It really tells you a lot. And again, it has a moat and it has a lot of assets, mainly nuclear assets, that cannot be replicated and they cannot be rebuilt in the modern age. And this is the reason why Constellation Energy has been such a good performer, and I believe it will likely continue to perform well over the next few years, is due to their exposure to nuclear. And this exposure to nuclear gives them something called the PTCs, or mainly the nuclear tax credits. Those nuclear tax credits, they provide Constellation Energy a floor on how much they can charge for the electricity, but no ceiling. So in other words, it provides them visibility of a minimum of 13% CAGR into 2030. And those credits, they don't expire before 2032. So they give them a floor, but they don't give them a ceiling. And that was implemented by a bipartisan bill in 2022. And I don't think there will ever be a ceiling, because if we have a ceiling on how much those companies can charge, then it's going to discourage additional supply. It's not going to make it as attractive. And we desperately need electrical supply in the United States with all the data centers and all the AI and autonomous kind of stuff that consume massive amounts of electricity. So the company is really in a sweet spot in a massive mega trend of the next 5, 10, 15, even potentially 20 years. Now, very recently, Constellation Energy has raised this outlook to a minimum of a 20% CAGR, from 13% to 20%. This is due to two reasons. The first reason is the recent acquisition of Calpine, which gives them a natural gas fleet, and it just provides them more growth in general. But the second one, which is a game changer, it's mainly the contracts with a lot of the hyperscalers. So for example, they have a 20-year deal with Meta to supply Meta for 20 years. They also have a 20-year deal with Microsoft to supply power to Microsoft for 20 years. Those contracts give them a lot of visibility, and they include a lot of price escalators, which is why CEG is very comfortable in guiding 20% CAGR for the next 4 to 5 years. And a bigger percentage of the revenues is now becoming contracted. And the more they can increase the contracted, the more visibility they will have, and the more they can raise prices within those contracts, as a lot of the hyperscalers are desperate to secure supply, and Constellation Energy is there to help them do that. Now, the best part about it is the 20% CAGR might end up being too low, and the company has a lot of levers that can take the growth way beyond 20%, up to 30% earnings per share growth for the next 4 to 5 years. And they can do it through two main ways. The first one is inflation. So if inflation ended up 3%, instead of 2%, that will raise their CAGR by 1%. If they buy back the stock, that will raise the CAGR by 2%. So those two things alone could take the CAGR from 20% to about 23%. And there's more and more opportunities that could take the CAGR up to 29, 30% for the next 4 to 5 years, and potentially even further. Now, the company, again, makes money in two different ways. The first one is the base earnings, which is mainly the nuclear tax credits and the long-term contracts. Then they have something called enhanced earnings. So if there's a lot of demand, they can sell the electricity way beyond the floor, which gives them something called enhanced earnings. So this is how I'm valuing the stock, and I might sound a little bit complicated, but I use the 1190 guidance for 2029. I want to get the earnings per share for 2030 to do a 5-year valuation model. So I put in times 20% to get the 2030 number, which is $14.28 in base earnings. Now, enhanced earnings is normally 40% of the total number. So I timed it by 60, I get about $9.28 in enhanced earnings. I added those two numbers together, I got $23.56 in total earnings per share. If I time it by 23 times earnings, which is the current multiple, and I personally believe it's a little bit too low, but even if we time it by 23 times, excluding buybacks, excluding anything that could take the growth beyond 20%, I get $541 per share by 2029-2030, which is almost a double from today's price. If it trades at 30 PE, which is the average PE for the company, and I would not be surprised if it gets back over there for the company being such a national security kind of stock, and I don't believe it's priced this way. I mean, you could look at Intel, look at other stocks. When you have a company controlling 8% of the electricity supply, I think it deserves a premium. Now, if it ever trades at 30 times, although I'm not betting on it, I get $700 per share, which is almost a triple, almost, over the next 4 to 5 years. If it trades at 35 PE, which is the peak multiple, this is $824 per share. And all of those, again, exclude buybacks, they exclude anything related to the stock. And the CEO himself believes the stock is undervalued, not just for the growth, but also for the quality of the assets of the nuclear fleet that cannot be replicated. And he said, in terms of the way I simply think of the stock, and we're trying to deliver the value we're trying to deliver to owners, is we're taking a look at the S&P and we're saying, what is the average multiple in the S&P? And then underneath that, what are the growth rates for different companies? What are their cash flow capabilities? And what is their long-term durability to have assets that are going to be around for decades? And this is Constellation Energy. The AI is not going to disrupt it. ChatGPT is not going to disrupt it. It's not Google or whatever, or even Meta, which I own those stocks, by the way. But those are hard assets. They are not going to be disrupted. They have a moat, they have a competitive advantage, and they have pricing power at least for the next 4 to 5 years. And they're giving you a 4 to 5 year guidance, which most companies can't even guide for the next quarter. He said so that when we show up and we present to you, look, in a very conservative way, we see a 20% CAGR. What we're saying is go look for other opportunities in the S&P, and we bet that our opportunity is going to be better than other things that you could find. And this is why I own the stock, and I'm holding it for the long term as a long-term mega trend kind of bet on electricity, and we'll see what happens. Now, the second stock is a stock that I bought recently. I shared it on YouTube. It actually did not get a lot of attention because it's a boring stock, and people like big techs, they like exciting stuff. But sometimes I buy the boring stocks, and actually those stocks, they do the best for me. And this stock is GFL, Green for Life. It's up 10.5% since I bought it like 5 or 6 days ago. I've been averaging up on the stock every day. I bought it 40, I bought it 42, and I share everything I do in real time in my group, by the way, all my trades and everything. And this is the link if you're interested. Now, GFL is a boring garbage company. So you could say maybe garbage will always be here. Even if we have war in Iran, the stock is going down. Garbage still has to be picked up. Taxes have to be filed. There's a lot of those necessity industries that will do well in a recession. Inflation even benefits them. And you just can't cut your garbage bill. And that's why they have the pricing power that they have. And they have a moat. They operate in the United States and also in Canada. Now, the moat of those companies is mostly through the landfills. And those landfills, they cannot be rebuilt. They've been licensed, they're here, and GFL owns about 90 plus landfills in the United States and in Canada. Now, most waste management stocks are really boring. They have little to no growth. But GFL is different. The company has grown 70 in CAGR, 20% CAGR adjusted EBITDA over the last 4 years, 23% in free cash flow. This is a waste management company. And they also expanded EBITDA margins. Now, I'm not going to go through details because my full deep dive was in this video and you can check it out. But with GFL, they also use the landfills and they use those waste kind of things they collect to generate natural gas. And they're having more and more natural gas fleets, about 23%. They're trying to get to 45% by 2028. So they ultimately can pretty much have like their own gas station where they generate the natural gas and they can use it in their trucks. So it's a really beautiful business model. Now, what I really like about GFL is they don't only grow organically, but they also grow through acquisitions. And they're really good at doing acquisitions. The average multiple is 7 times EBITDA. GFL trades right now about 13 times, and the majors like Waste Management, Waste Connections, they trade between 15, 16, 17 times EBITDA. So you can see a lot of the value creation that's being implemented here, and the company is well known for doing acquisitions and not overpaying for them. Now, the reason why the stock has gone up over the last 2 days, and it's well justified, by the way, is the company has entered into an agreement to acquire a waste management company in Texas called Frontier. And they talked about it. It's supposed to be a really large acquisition, like 900 million. But the company also acquired other companies during the quarter. And the total revenues, they believe it could be about 425 and 450 million in annualized revenue. But then they talked about it on the latest report, and they said we are positioned to meaningfully increase our guidance for 2026 when we report our first quarter result later this month. So if they increase it by 10% and the stock went up 10%, maybe a lot of it is justified and the stock is still priced like it was when I bought it a few days ago. But most people, again, they get influenced by the stock price and they believe it's like 10% more expensive, while it could actually still be priced at the same rate. But we're not going to know that before the next report. So it's a mix of acquisitions and organic growth. The company or the stock hasn't performed well over the last few years because it was well known as a leveraged up acquirer of companies. Like they were trading at 7.7 times net leverage to EBITDA. 7 times is extremely high. They cannot be included in a lot of indices. And 7 times was just too risky. Now they lowered it to 4 times, and it tend to lower it to the low threes over the next 1 to 2 years. And if they can lower the leverage ratio, they will get a multiple expansion relative to Waste Management, Waste Connections, at least if they just trade at the same multiple, even though the company is growing 2 to 3 times faster than Waste Management, Waste Connections. But if they can just lower the debt, they can be included in the S&P 500, they can be included in other kind of indices, and they can also get a multiple expansion to match Waste Management and Waste Connections. Now, if you look at the company's guidance for 2029, the company is guiding about, for adjusted EBITDA, about mid-teens. The industry normally grows high single digits to mid-single digits. So the company is growing double the industry rate. For adjusted free cash flow CAGR, the industry normally grows about high single digits. GFL is guiding low to mid 20s. So this is a boring waste management stock. It doesn't correlate too much with the markets. It's not going to be disrupted by AI, but it's also growing low to mid 20% in free cash flow, and it's trading at about 25 times free cash flow, excluding the potential increase in guidance that we're going to get later this month. So again, 24, 25 times cash flow is growing 23 to 25 times in free cash flow, percent in free cash flow. So you're paying one-time price to free cash flow growth. I don't believe the stock is expensive. I believe it's still fairly valued, you could say. And a lot of people have asked me about the potential fuel increases, fuel price hikes that they can experience, which could pressure the margins. But GFL has been moving into what they call a fuel surcharge program, which means they can pretty much take the difference in diesel, the difference in natural gas or whatever they use, and they can charge it to the customer as a fuel surcharge. Now they have about 50% of the customers in a fuel surcharge program, but they expect to have 100% by 2028. So it's not going to impact them as much as you think. And those are the two stocks I bought the dip on over the last few days. Constellation Energy recently, and GFL I bought the dip on on it 2 times, and I share everything I do in real time in my group. This is a link if you're interested, and I have much more stocks that I intend to buy. And thank you again for watching. It was not financial advice. I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.